Welcome to number 2 in the cash flow series. Number 2 is all about learning what types of deductions to your incomes are and really doing something about the ones that are bad. So let's talk about it in terms of expense and liabilities. Now, expenses, you're going to be pretty familiar with them. They're a beer, something small, or going on a holiday to South America, getting a new car, something like that. You can tell it's an expense because it's one-off, so you can tell exactly how much you're spending on something. Number 2, if you don't have the money, then you just don't get it. And number 3, probably the best part about it, is you'll get a positive emotional reward from it. The bad ones, the bad deductions from your income are liabilities. Okay, so you're not gonna have a positive emotional reward from it because who's ever been stoked about getting a bill in the mail, right? Because these liabilities are ongoing costs, right? Number 2 is because it constantly happens, it's hard to track exactly how much money you're paying for something, right? If something's $80 per month, it's hard to tell how much exactly you're gonna spend on something. And number 3, whether you have the money or not, it's a monster that just wants to get fed. So identifying if something's a liability or an expense will help you dramatically. Now you know what a liability is, spend your time on reducing these. Now, why is that? Well, if I did the same amount of effort on an expense, every time I spent money, I'd have to try and figure out the cheapest option. Over here, a liability, it's happening in the background, right? So if I spend my time and I focus on, say, reducing rent or mortgage, refinance your mortgage, or get a cheaper phone bill, do something, spend a bit of time and shrink those liabilities. Because the smaller the liabilities, the more you've got to spend on things that will give you a positive reward.